Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Japanese stocks jump while the yen weakens to a July 2024 low after Kyodo News reports that the Prime Minister intends to call a snap election. The Trump administration's Fed probe triggers a backlash in Washington, with key Republicans voicing their concerns. And President Trump vows new tariffs on countries doing business with Iran effective immediately. Well, it's just gone 9 a.m. across the Emirates. I'm Joanna Versace in Dubai. As ever, the news flow just comes thick and fast. Today, we're focused on developments in Japan. We're going to talk about that shortly with the possibility of a snap election. Also, Trump saying overnight that he is looking to impose a tariff of up to 25% on countries that still trade with Iran, i.e. the biggest one is China in that regard. So we'll see how all of this plays out. Later on the show, we have the head of Commodities from Goldman Sachs joining us. So stay tuned for that conversation about half an hour. So we're going to speak about all of the latest geopolitical developments and what that means for oil and commodities as a whole. But as for markets, what you're seeing is, well, S&P futures sitting at 7,000. That's a key, very nice, aesthetically pleasing number. But point is, we did see some stabilization come through for Wall Street yesterday. A bit of fear in the morning yesterday after the Department of Justice subpoena came through. But later on throughout the day, we saw Trump actually distancing himself from that decision. Again, we'll talk more about that on the show. But some stabilization for U.S. equities by the end of the day. Handover from Asia Pacific this morning, very strong indeed, up more than 1%. So brushing off yesterday's cobwebs, I would say. 10-year yields also down at about 4.17. At one point yesterday, we did get up to 4.2%. Big event for markets today. We have the CPI print in the U.S., so watch out for that. The expectation is that we're going to get a year-on-year number of 2.7%. And not just that, also, we will begin with the earnings season. And today it's the banks that are in focus. JPMorgan will be reporting. So we're going to preview that as well in the show. And then Brent, take a look at where oil is, continues its climb higher. We are up more than 5.5% in the last 5 trading days, sitting just shy of $65 here. $64 is where we're at. Now, I did mention bank earnings coming up. Let's switch over, because there is something that I want to show you, which is essentially a chart that tells you how well the banking sector has done over the course of the last years. We know 2025 was a bumper year for bank earnings, stock prices. But look at what happened in the last couple of days. This is just literally Thursday, Friday of last week. We came down a lot. Why? Because of President Trump saying that he's looking to impose a cap on the credit card rate that banks charge. So that will eat into the bank's margins. And that's one of the reasons why you saw that little drop towards the end of the week last week, and is something that will feature heavily during the course of this upcoming earnings season. So something to think about there. But let's get back to a big story in Asia overnight. Japanese stocks are jumping while the yen is weakening after reports that Prime Minister Sanae Takaichi intends to call for a snap election. For more on this, we're joined by Brian Fowler, our senior editor in Tokyo. Brian, what do we know, and why does the Prime Minister want to call a snap election?
Yeah, so let's start with what's at stake. So right now, the LDP-led ruling coalition has a majority in the lower house of exactly 1 seat. So it could hardly be more fragile. And Takaichi wants to seize the moment and build on that while she thinks she can. The risks are very high. On the one hand, she's had very high support ratings in the 70%, as high as 80% in some surveys. So that's historically unheard of. She's got stronger support than I think I've ever seen in my lifetime for a Japanese prime minister. So that's looking good. On the other hand, the LDP as a party has not fared quite as well in surveys. People are still a little bit unforgiving towards past scandals in the party. And more importantly, or at least as important, the ruling coalition now is different from what it was in past elections. It's now the LDP with the Japan Innovation Party. Japan Innovation Party has a very strong base in the Osaka area, but it's not really tested in terms of nationwide elections. The previous ruling coalition partner was Komeito, which was famously strong at getting out the vote on the ground. So this would be Takaichi taking a risk going into a national election with a fairly unproven partner, to carry the flag. And so there's a lot at stake here, and it might not go that well. It did not go so well for her predecessor, Ishiba, when he tried to do the same thing in the autumn of 2024. But who knows? Maybe she can pull it out where he could not do so.
Okay, so thank you for breaking down the incentives to do it, and also the fact that she is sort of riding this wave of popularity. Assuming she succeeds with this gamble and actually manages to consolidate more of their support, what are the knock-on implications for fiscal policy in the future? How should we read this as market participants?
So Takaichi is famously in favor of stimulative policy. She just put together a massive stimulus program that passed Parliament last month. She's also put a plan together for the coming fiscal year for the biggest budget we've ever seen. And that's kind of where she stands. She wants to boost the economy with fiscal spending. I think we've seen the reaction in the markets today. Stocks are loving this. Bonds and the yen, not so much. And I think the idea is if she does go and win this mandate, she's probably going to continue with what she's been doing. She's going to take this as a vote that Japanese are in favor of all the steps she's taking to sort of mitigate the pain from inflation. And I think we would see more spending going forward. The election would be called pretty soon, according to local media reports. She would dissolve Parliament Friday, the 23rd of January, and we might get the snap election as early as February 8th. So there's not a lot of time for the opposition to plan its strategy. And I guess that's also a question, where's the accountability?
Okay, Brian, thank you so much for bringing us the latest in Japan. Could be quite market moving. Now, the Trump administration's actions against Fed Chair Powell have triggered a backlash that could derail plans to tighten White House control over the central bank. Fed officials and U.S. senators from both parties have pushed back on the investigation and reiterated the importance of an independent central bank.
Throughout that time, he has been completely dedicated and committed to the Federal Reserve's mission to support the American people. And throughout that time, he's proven himself to be a man of impeccable integrity, and a man who has been calmly leading the Federal Reserve through times of heightened uncertainty and led us very effectively.
That's what this probe is. It's a pretext. It's a way to try to knock the legs out from Jerome Powell. I'm no Jerome Powell supporter, but I am a supporter of Fed independence. And the weaponization of the Department of Justice is fundamentally wrong.
For more, our chief Asia correspondent, Rosalind Matheson, joined us now from Singapore. I mean, really fascinating, Roz, how this has evolved over the last 24 hours. A huge amount of pushback from many policymakers, and even President Trump himself seems to be distancing himself a little bit from the DOJ's decision.
Well, that's right. In a way, some people are saying, why didn't Donald Trump or the DOJ simply wait? Because come May, Jerome Powell is no longer the chair of the Fed. Obviously, the key thing is he then going to stay on as a governor, because his term there doesn't expire till around 2028. Is this idea to try and ensure that he departs entirely come May and is no longer involved with the Fed at all? Is this what this was about? Because as you were saying, there's been a blowback to this on both sides of the aisle. Some quite significant Republican Senator Tom Tillis, of course, who's on the Senate Banking Committee, saying that he's not going to approve any new appointments for the Fed until this legal issue is cleared up. And if he breaks ranks, that means that there's no Republican majority on that committee. That means potentially that these nominees don't get out of committee and don't get to a full Senate floor confirmation vote anytime soon. So does that, of course, have that repercussion for Donald Trump? It's interesting to see that. But was the idea behind this to try and get rid of Jerome Powell entirely? And if so, is he simply just going to dig in and stay?
Ross, thank you so much. Rosalind Matheson, Bloomberg's chief Asia correspondent, with the latest on the Fed and that Department of Justice subpoena. What a story. All right, coming up, we'll discuss the outlook for markets in 2026 amid the global economic backdrop with Alexandre Tavazzi from Pictet Wealth Management. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersecci in Dubai. Well, we're going to talk about markets and the market price action since the beginning of the year, starting the year off with a more positive foot. For more market insights, Alexandre Tavazzi, head of CIO Office and Macro Research at Pictet Wealth Management, is with us. How are you feeling about 2026? Do you feel like this very short window of optimism that we've seen in the first week of the year is going to continue?
Well, you can choose your pick. 20 days already in the year and quite amazing news. Venezuela, Iran, a lot of things to talk about. But especially a lot of things that took place in 2025 will not take place in 2026. So this is a backdrop of our scenario for 2026.
Okay, and where do you think the growth catalysts are going to come from?
Fiscal will be a big issue. We just heard the Japanese issue. We'll have OBBA bill in the US, certainly stimulating investment. We also have a 500 billion euros worth of new investment done in Germany. So fiscal will be a big issue behind the growth that we expect for 2026.
When people say fiscal, my mind turns to inflationary. Do you see that happening this year? I was speaking to another guest yesterday who says because of all of this fiscal impulse, because of the pressure on the Fed that's going to come to be more dovish, would not one of the unintended consequences be a resurgence of inflation?
That could be one of the major risks. In our view, in 2026 in the US, you should have inflation at around 2.9%.
Okay.
So this is going to be a key issue for the markets, especially if on their side the Fed decides to cut rates at a time when inflation remains stickier than what most of the people expect.
Yeah, and how do you position for that?
Well, then you have to be careful on the bond side. You have to be short in duration on your bond exposure. You maybe have to look for other bond markets, except in the US, where in the US you still have this doubt about the long end of the yield curve, which may be under pressure because of what we have just talked about.
Can I ask you about one of the big stories that emerged the last 24 hours, the Department of Justice subpoenaing the Fed, but obviously there has been a bit of blowback, in the last 24 hours from US politicians. How much, as an investor and a market participant, does that affect your appetite to invest in U.S. assets? Yesterday, once again, people were talking about de-risking away from the U.S. on announcements like this.
Well, it tends to favor U.S. assets because if you have a monetary policy which is in favor of lower rates, that should be positive for U.S. assets. But then it's all about the U.S. dollar and the confidence one can have in the U.S. dollar. Look at the market's performances last year. The U.S. was double-digit. The rest of the world was double-digit. But the dollar declined more than 10%. So from a U.S. dollar perspective, U.S. investors, when they have invested overseas, they've made a lot more than what they have made in their own stock market. So the dollar is the ultimate victim of what we have just talked about.
Do you see that continuing this year then? And
yes,
if so, which currencies would you want to buy?
Well, the emerging currencies are very, very interesting. EM currencies, because if you look at the yield you can get, also on a real basis, those are quite attractive, with companies which are a lot less levered than the US and a much better yield you can get. So these are, to us, the most attractive ones. We can put the euro as well, given what is taking place in Europe. And if you look for any safe haven currency, well, the Swiss franc is there for investors to grasp.
Yeah, well, being Swiss, I guess, or being domiciled in Switzerland, there's a bit of a home bias. But no, absolutely, I take your point. Other safe havens, gold, silver, performed extremely well in the second half of the year last year. Do you expect that also to be a feature of 2026? I guess my question is, how is 2026 going to be any different from 2025 in terms of the assets that are outperforming? It seems to be the same playbook.
Seems to be the same playbook, but the currency is central. When you look at the world and you look at what the governments are deciding, you really have to be careful about the currency. And most of what we do in our clients' accounts is to center most of their assets in their own domestic currency, so about 70%. This is the number one determinant of your performance in 2026. But otherwise, assets are doing great, except on the bond side, because of what we have just talked about, which is inflation maybe getting a little bit higher than what people expect.
It has been a year where we've been inundated by geopolitics, right? I mean, the Trump agenda has been very, very strong on Venezuela, on Greenland agenda, on Iran now. And again, as a market participant, how do you factor all of the geopolitics into your portfolio construction this year? Or do you just brush it off because it tends to not have a lasting impact?
Well, it may have a lasting impact because so far everything we have seen has not led to a rise in oil prices, which remains one of the key determinants. You have to be
beginning to.
Yes, it is beginning to, but you have to be widely diversified and have some room for any optionality in your portfolio. And today, that optionality is played by precious metals, as you have just mentioned.
Yeah.
We started the year with a gold price target of 4,800, but given what is taking place, we may get there very fast, which then means the gold prices will continue to move higher.
The clients that you speak to on the private side, I'm guessing they do want exposure to precious metals. They want to have this barbell. They want the safe haven protection, but then also they do want exposure to stock markets, to equities if they continue to rally. How much excitement is there this year around the AI theme versus at the beginning of 2025? How would you compare?
I think people are having a lot of questions because if you look at last year, out of the max 7 names, only 2 have outperformed the S&P 500. So the market is starting to concentrate. People are looking at the message coming out from the credit markets, which is for some companies having an issue. So I think people really want to see whether those companies can monetize the AI infrastructure and the technology so that they don't have to ask too many questions about the profitability and the ability of those companies to pay the debt that they have raised in 2025. I think that remains a key question mark in our clients' mindsets.
Okay, great. Good to chat to you. Thank you so much for coming on. Alexandre Tavazzi, Head of CIO Office and Macro Research at Pictet Wealth Management. Well, coming up, U.S. President Donald Trump ratchets up pressure on Iran with the threat of new tariffs. We'll speak to William Roebuck, former U.S. ambassador to Bahrain and executive vice president at the Arab Gulf States Institute. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. U.S. President Donald Trump says he's imposing a 25% tariff on goods from countries doing business with Iran, ratcheting up pressure on the government in Tehran. The announcement comes after weeks of mass unrest in Iran, which was initially sparked by worsening economic conditions, but has increasingly been aimed at the regime. Joining us now is William Roebuck, former U.S. ambassador to Bahrain and executive vice president at the Arab Gulf States Institute. Let me ask you about the decision overnight from President Trump to impose that 25% tariff on countries still doing trade with Iran. And we know the biggest buyer of Iranian oil by far is China. Is this one way for the U.S. to exert extra pressure on the Iranian regime without necessarily getting involved directly?
That's right. I think they're probably looking at their options, and they're weighing also President Trump's rhetoric so far, and they're looking for tools that they can use in the toolkit. And I think President Trump is comfortable using tariffs. I don't think it's going to have much impact inside Iran. I think it might have some impact on our economic relations with China. That's a different subject. So I don't really see it as a very effective weapon, but I think it's a tool that at least he can show that he's doing something if he decides not to go to more aggressive means through military steps.
And it seems as though the U.S. and Iran are somewhat reopening up the diplomatic angle, the diplomatic channels as well. The foreign minister allegedly spoke to Steve Witkoff over the weekend. And what hope is there at this point for a diplomatic solution that at the same time would allow President Trump for the off-ramp to not get involved so long as these demonstrations are still taking place?
It's going to be tricky. I mean, I think they possibly could work something out if it happens relatively quickly. And what I mean by that, right now, it's a very tough situation inside Iran. The regime clearly feels deeply threatened. They are using very heavy levels of lethal force, violence, to suppress these demonstrations, and the death toll has already mounted, according to estimates that were given, of about 500 to 1,000 people killed and 10,000 injured and another 10,000 in prison. So it's already getting quite dramatic. If the Iranian regime and the U.S. government are able to find an off-ramp relatively quickly before the bloodshed gets too bad, it's possible the Trump administration could see a way to do that and see some advantages to it. But I think if the blood toll gets too bad, if it goes on too many days, too many weeks, and so many people have been killed, it's going to be difficult, I think, for the Trump administration to find a way to reach a diplomatic settlement.
Yeah, most definitely. Do you see this as the beginning of the end for the Iranian regime?
I don't. I think this is a very tough, cohesive regime. They're clearly under very deep threat, and they're doing very intense measures on the repression side to get past it. But I think the regime is relatively cohesive. I don't see that a collapse is imminent. And I think they probably are going to get through this crisis. They're still going to face the economic problems they have. It's going to be a weaker, more brittle regime, but my sense is that they will get through this. I don't think nonviolent protesters can bring down a regime that's this determined to use violence.
What if Israel goes down the route of, once again, intensifying the conflict and targeting the regime?
That's a different matter. That's a good question. I do think external force obviously could shove this regime aside if sufficient levels of it were used. What I've seen in the Israeli media and press so far, and my sense of what I hear, is that they're not interested in intervening right now. They don't see it, I think, in their interest, and they also calculate that military force would rebound against the protesters. It would undercut their messaging. And my sense right now is that Israel is on the sidelines and is weighing the situation, trying to send some messaging to encourage the protesters, but that's it.
I've got a minute, but let me just ask you, what are you watching out for in the coming week to determine where this goes?
I think it's the level of violence that the regime feels like it's going to have to continue to use to put these protests down. If they are able in the coming few weeks to sufficiently intimidate enough people to get off of the streets and to use messaging, to use religious threats, really, injunctions that they feel they have, and they're clearly sending that message. If they can stifle this in a few weeks, I think they will move on and do, they'll focus on other things and they'll get through this crisis.
Yeah. Great to have you on. Interesting perspectives. William Roebuck, Executive Vice President of Arab Gulf States Institute and former U.S. Ambassador to Bahrain. Coming up, we're going to be talking about oil as they touch the highest level since November. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Japanese stocks jump while the yen weakens to a July 2024 low after Kyodo News reports that the Prime Minister intends to call a snap election. The Trump administration's Fed probe triggers a backlash in Washington, with key Republicans voicing their concerns. And President Trump vows new tariffs on countries doing business with Iran, effective immediately. It's just gone 9:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Well, yesterday the big news when we walked in the morning was the fact that the Fed had been subpoenaed by the Department of Justice. A lot of backlash came through from policymakers yesterday. Even President Trump himself has been distancing himself from that Department of Justice decision. And so what we saw by the end of the session yesterday was Wall Street did actually manage to eke out some gains. Treasuries rallied back again. So maybe you could say that the storm is over on that particular story. But of course, a lot of pushback from the Fed chair himself, Jerome Powell. This is the picture this morning. S&P futures still tracking above 7,000. We're down about 9 basis points, but still we're up positive in yesterday's session. The handover from Asia Pacific quite strong as well, up 1%. A lot of focus on Japan. We were just talking about that, the possibility of a snap election. In a moment, Winnie will run us through those markets. 10-year yield sitting at 4.19. I should mention there's important data coming up today in the U.S. We have CPI. The expectation expectation is it for a 2.7% year-on-year print, so watch out for that. Later on, could be quite market moving. And then we get the beginning of earnings season with JPMorgan reporting later on in the session as well. Remember, credit card cap will be featuring heavily. I'll get to that in just a moment. But before Brent, take a look at where oil is trading. $64 now. We are up 0.3%, up more than 5% in the last few days on back of the geopolitical premium from Iran. Switching over, though, the board that I want to show you today is the one vis-a-vis Trump's proposal to cap credit card interest rates. And you can see that up until essentially a couple of days ago, it's been a magnificent run for banking stocks ever since the lows of April last year. It's been quite a strong year for the U.S. banking space. And just in the last couple of days, we've tipped downwards because of what Trump's been saying about capping some of those credit card interest rates, which would obviously hit the margins on banks and banks lending. So something to think about as we head into the earnings season. Okay, let's also check in on how markets in Asia are faring this morning. Winnie Su is in our Hong Kong studio. Winnie.
Yeah, morning, Jomana. We're really seeing that Takaichi trade back to life again, right? While expectations are really growing around her snap election, we are seeing that benchmarks here, Topics and the Nikkei, both up more than 2% to fresh records as market reopened from holiday. But at the same time, we're also seeing the Japanese yen, like you mentioned just now, weakening to that lowest level since July 2024 and now inching towards that 159 level against the dollar, even after Finance Minister kind of cautioned around the weakness of the currency. Yields also steepening, bonds falling. That's still being driven by expectation for further stimulus and more fiscal budget to come. Now you flip the board and take a look at what sectors are moving on that trade. You can see that defense sector here, Kawasaki Heavy, and AI trades, as well as nuclear-related names are jumping because these are Takaichi's strategic focus. And in the meantime, Toyota, which is a key exporter of Japan, also rising on the weak yen. Flip a board and you also take a look at what other is moving in the Asian market. So the Korean won actually is another currency that we're watching very closely because of its weakness. We're talking about it headed for its longest losing streak since 2008. And that has been driven by how local investors are pulling funds away from the country. And speaking of which, Kospi still is rising to another record. And now the Korea Stock Exchange is actually planning to extend its trading hours to 12 hours per day from 6.5 starting this June. So that's also a key area that we're watching in terms of the development. Back to you, Jomana.
Yeah, and also let's not forget the stellar 2025 performance out of the Kospi as well. I believe at the end of the year up something like 70% or so. Winnie Su in Hong Kong, thank you so much. Well, oil touched the highest level since November after U.S. President Donald Trump said he's imposing a 25% tariff on goods from countries doing business with Iran. Energy prices have gained ground in the early New Year period following a run of 5 monthly losses spurred by expectations of a glut. Joining us now, Daan Struyven, co-head of Global Commodities Research and head of oil research at Goldman Sachs, joins us. Well, it's been a busy start to the year for you, I'm sure, in 2026 with all of these geopolitical events going on. Let me start with Iran. How closely are you watching the uprising? Because so far there doesn't seem to have been an actual physical impact on oil.
Yeah, good morning, Jomana. Definitely a busy start to the year. Yeah, we're very focused on actual potential disruptions to oil supply from Iran, which exports just over 2 million barrels per day, which is about 2% of the global supply. So far, no disruptions. In theory, there are several potential paths to disruptions of barrels. The increased risk of disruptions to barrels explains why the geopolitical risk premium is back. We're laser focused on this, but we have not changed our base case that an oversupplied market will see prices trending down. In a way, we think history in 26 will repeat itself, the template of 25, where we had several geopolitical risk premium spikes, but an oversupplied market and a downward trend in prices. Our forecast for 2026, with Brent averaging 56, is similar in that regard to what happened in 2025.
Okay, so almost $8 lower than where we are right now. I'm going to ask you about the fundamentals in a moment, but let me just also ask you about the news overnight that Trump is looking to impose a 25% tariff on countries still doing business with Iran. We know China is the biggest buyer of Iranian oil. If he actually follows through with that, and if, by the way, the Supreme Court actually deemed these tariffs to be legal, which is another big question mark, could that have a noticeable impact on the oil market in the sense that this Iranian oil will have nowhere to go?
So in theory, yes, but I think those are two important ifs, two important conditions that you outlined. I would make two observations. One, the U.S. administration has imposed similar tariffs on buyers of Russian oil. And Russian barrels are still being exported. That said, if we were, for instance, to see a 50% drop in Iranian exports from about 2 million barrels per day to 1 million barrels per day, our models would suggest that the fair value of oil prices, based on the level of inventories, would be $8 higher, all other things equal, after 1 year. The actual price effect could be somewhat larger if the risk premium, geopolitical risk premium, rises further. But that's not our base case, to be clear.
Yeah. Okay, fair enough. Thank you for giving us the context around the numbers as well. Let's talk about fundamentals and the fact that you do see Brent averaging $56 this year, namely on back of a huge surplus that you're forecasting, 2.3 million barrels a day. Have you started to see these OECD inventory stocks rising significantly in the last quarter of the year?
Yeah, great question. So last year we estimated the market was in a 1.5 million barrels per day surplus, but only about 200 KBD of those global builds showed up in the OECD commercial pricing centers. And historically, those inventories, which are more salient, better measured, especially in the US, tend to be more important for price dynamics. The reason that the builds in the OECD commercial pricing centers have been so limited last year, despite a large surplus, is a very large rise in oil on water, both from sanctioned producers such as Iran, Russia, and Venezuela, but also related to the broad increase of production in places like Brazil and the US. History suggests that once oil and water has surged, oil and water inventories typically tend to normalize. We assume slight moderate increases. We have China buying, stockpiling at a 500 KBD pace. But if you have a 2.3 million barrels per day surplus on the back of broad-based supply strength, which is our base case, I think it's reasonable to assume that about a third of those builds will happen in the OECD. Our pricing framework is primarily based on OECD builds, but I have an open mind. Last year, prices trended down. And if you actually plot the downward trend in oil prices in 25 against global stocks inverted, the two lines are very much on top of each other. So the market may be putting a greater weight on global stocks, I think, as those have become better measured in an environment where we can all track with satellite data the builds in global oil markets, not only in the OECD.
Yeah. Okay, fascinating. I can't let you go without asking you about Venezuela and the fact that the Trump administration is obviously very keen to have these international oil companies invest. You had the likes of ExxonMobil saying that Venezuela is, quote, uninvestable. What do you see as the supply actual potential of Venezuela in the coming years? I mean, how quickly are they going to ramp this up, or do you expect things to get ramped up?
So I would distinguish really two periods. In the short term, I think there are some low-hanging barrels from Venezuela that can come back to the market. In fact, we nudged up our forecast for Venezuelan crude production. They're currently producing 800, 900 KBD to 1.1 million barrels per day by the end of this year, as several companies, including at our GS Energy conference, have told markets that with limited investments in existing assets, with some workovers on their fields, they can bring some low-hanging barrels back to the market. In contrast with the long term, where I think it will take a lot of time, a lot of investment and clarity on the policy context, both in Venezuela and the US, to see more substantial increases. And so there we have a more cautious forecast. By 2030, we have Venezuelan crude production only at 1.3. That's higher than where we are now, but still significantly lower than where we were 20 years ago, when Venezuela produced 4% of global production. But I think those low-hanging barrels can come back with relatively limited investments. And I think the U.S. administration is also quite focused on seeing those barrels coming to the market, in part because they're very attractive for the U.S. refiners that have been built in an era where Venezuela was a major producer.
Yeah, so interesting. It's also the first time I hear the term low-hanging barrels and not low-hanging fruits. Dan, good to have you with us on the show. Thank you for joining us, as ever. Daan Struyven, co-head of Global Commodities Research and head of oil research at Goldman Sachs. Now, the U.S. hosted a gathering of G7 ministers on Monday to discuss the availability of rare earths. The meeting came as G7 countries are under growing pressure to develop alternative supplies in a crucial industry dominated by China. For more, Martin Ritchie, our metals and mining reporter, joins us from Shanghai. Interesting sort of off-cycle G7 meeting that's taking place, Martin. Walk us through the rationale. Why are the foreign ministers holding this meeting?
It is interesting. So obviously from last year when China started restricting the flows of rare earths, there's been a lot of interest in building up alternative supply chains. We've seen a lot of unilateral action from the US in terms of putting money into its own projects, putting some cash towards mines, say in Australia and other places. But on a multilateral level, they're still trying to coordinate what a future system might work, and that's being done under the auspices of the G7. But this meeting seems to have brought the finance ministers together just to sort of, as far as I can make out so far, just to sort of say, here's what we need to do. There's all these things we discussed last year at previous meetings. There was one in Toronto with energy ministers. Here's the things we want to do. We want minimum floor prices. We want sort of more trade protections against Chinese exports in future, and we want some more action on things like recycling. From what I can gather, the comments from the German finance minister seem to point towards some kind of contentions or challenges around coming to agreements on this. So it looks like to me that the meeting was called for the US to sort of try and put pressure on the rest of the bloc to make progress. And I should say that there was also representatives from the European Union, from Australia, from Mexico and India also there, all countries which also have a stake in future rare earth supply.
Bloomberg's Martin Ritchie in Shanghai. Thank you so much for the preview ahead of that important G7 meeting. Now, coming up, the South African Reserve Bank is looking at overhauling its prime lending rate. More on the significance of that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. The South African Reserve Bank is reviewing the prime lending rate that commercial banks use to price billions of dollars of loans to clients. It has been fixed at 350 basis points above the country's monetary policy rate since 2001. For more, our chief Africa correspondent Jennifer Zabazaja joins us now. So walk us through the reforms the central bank is considering. Why now for a rate that seems to have been fixed for so long above the base rate?
Right, Jumana, if you take a look at what one analyst said, really taking a look at this is long overdue. If we take a look at historically what we've seen, there have been previous reviews of it, but there's been some concern about potentially what the cost then would be if there is in fact a change to this rate, or to at least the spread of the rate to commercial banks and also to some of the contracts. And there was actually a previous study that was done almost 2 decades ago by the Banking Association of South Africa that actually described the size of the spread over the key policy rate as immaterials, what they described it as determinant of lending rates. And so there haven't been any changes made. But as Bloomberg has been reporting over the past few months, we've seen quite a bit of reform momentum from this central bank. If we take a look at just one aspect of it, there was overhauling the cash system so to be more digitally enabled. And then there was also some implementation of a new monetary policy framework. And so we are seeing this central bank at least seeming like they're willing to conduct some reform. So potentially, if we take a look at what some of the changes could be, there could be a decrease, at least in the spread of the monetary policy and the prime rates. But then also, there's also potentially some discussion about abolishing this altogether. But the real question will be what potentially are the implications for some of these existing contracts and mortgages that are out there. That is still up for discussion.
There's the outstanding, but then if you look to the future, obviously this would be welcome news for anyone looking to borrow, but not necessarily great news for the lenders. So how do analysts see this?
Well, it's interesting, Jumana. There seems to be various aspects of this. If you take, again, a look at this specific study that was done still quite some time ago, but if we reference it in particular, it saw that over the long term, potentially narrowing the spread would not make much of a difference in terms of the interest that is paid or the interest that clients are paying just because they are being assessed based on risk. But then if you take a look at what another economist suggests, she potentially sees that over the short term, narrowing the gap could actually lead to reduced consumer debt service costs, easing of financial constraints, and also potentially improved access to loans for businesses. So there's sort of two sides of the coin, it seems, especially if you take a look at, we talked to some analysts who suggest potentially this opens the door to more clients who are looking for loans. So there is still that liquidity flow for banks. So, if we just assess what the central bank has done in the past, they like to at least take a look and get some questionnaires out there with the market participants just to see what the mood is like if, in fact, they do pursue a change of this matter. They haven't discussed the specific timelines for when this could happen, but it's seeming like there is a bit of reform momentum still existing within the central bank. And if there are some positive green shoots and we do continue to see at least inflation subsiding a bit in 2026, as it's expected to in South Africa, potentially we could see some of the changes that could, as some analysts point out, lead to more economic growth.
Jen, thank you so much. Jennifer Zabazaja, our chief Africa correspondent. Now for a look at some of the other stories we're following today. Somalia says it has cancelled all agreements with the United Arab Emirates, citing strong evidence of actions undermining the country's sovereignty and unity. The government says security, defense, and port and commercial agreements have been cancelled. The UAE didn't immediately respond to an email seeking comment. The Democratic Republic of Congo is sending its first shipment of copper to the United States under a new partnership backed by Mercuria Energy Group. State miner Geka Mines says it will ship about 100,000 tons of red metal from its share of production in the Central African country. The partnership is part of a strategic agreement signed with Washington to challenge China's dominance in supplies of key metals. And coming up, JPMorgan kicks off earnings season for U.S. banking majors today. The lender's credit card business is suddenly in focus. We'll have the details next. This is Bloomberg.
We believe that the current proposals are not really reflecting what happened at Credit Suisse and are going too far. And therefore, we are contributing in the debate with our views on the matter. But this is now a political process. We hope we're going to get more clarity by the second half of the year.
That was the UBS CEO Sergio Ermotti commenting on the proposed new banking regulations in Switzerland that could impose as much as $26 billion in fresh capital requirements on the lender. And of course, they have been pushing back. And the Financial Times is reporting the UBS chief executive plans to step down in April of next year. Charlie Wells is here with the latest, as well as a preview of Wall Street earnings this week. So first, let's talk about Sergio Ermotti and his potential departure in April of next year. I remember when he was brought in to deal with the takeover of Credit Suisse. At the time, we knew he was going to be in the position for a couple of years. What do we think about this new timeline?
Well, Giovanna, this officially kicks off a leadership race at one of the world's largest and most significant banks. And this had been telegraphed that Modi would be at the bank to oversee the integration of Credit Suisse into UBS. And so this is a part of a plan to try to bring this in a stable way. This is very much in line with the way that Modi has had in his second tenure. And so it's interesting. The FT has been reporting that the date is not set in stone, but it would be an opportune moment because it would come around the time of next year's annual general meeting. So bringing in that issue of stability, of transition, that has very much been a part of Modi's tenure in his second round as the head of UBS so far.
Yeah, the successor race is on. Okay, let's pivot and talk about bank earnings. Wall Street banks are kicking off their fourth quarter earnings season today. JPMorgan, first off the block, what should we be watching out for?
Well, look, so it's been a little bit of a rocky start this week, not what banks necessarily may have wanted, given some announcements coming out of Washington, for instance, about potential caps on credit card fees of 10%. That has sent bank stocks down, at least yesterday, those major issuers and banks that do issue credit cards. So that's been one surprise. We've also heard announcements about job cuts at the likes of Citigroup and at BlackRock on the asset management front. But thinking about JPMorgan, first to report today, really kicking things off, this should be a solid report. They're on track to have some of their best profits in the history of American banking. So don't let some of this noise scare you. At least that's the take from some analysts. And what we could see is strong trading, strong deal making, and again, an expansion of that loan book that we've seen in the Trump era in a looser regulatory environment.
Well, that JPMorgan, the forecast on equities, a growth of more than 31%, certainly stands out. Let's see what comes out later today. Thank you, Charlie. Well, that was it for Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai.